Hello everyone, this is Kelly Duan. In this video, we will learn all about data basics. The learning objectives for this video are listed here. We will first build a fundamental understanding of data. We then start by looking at what data is and the key characteristics that define it. Then we will explore different data sources and types along with the scales of measurement used to classify information. We will also learn how to interpret common data representations so you can quickly make sense of what you are saying. Finally, we will cover the basic of data profiling and essential data preparation techniques to ensure the data we are working with is accurate, consistent, and ready for analysis. Let's get started. The first question is, what is a data? Data refers to raw facts and figures we can collect it from various sources. Data is the starting point of all information systems. It includes any unprocessed pieces of information, such as numbers, text, images, or sensor readings. On its own, data has no meaning until it's organized or analyzed. When data is analyzed, sorted, and interpreted, it becomes information that can provide some meaning and context of that data. And that context helps people make decisions. The transformation from data to information is often done using technology. So the process of examining and interpreting data to uncover insights and unknown pattern is known as data analytics. It uses different techniques to identify trends, correlations, or problems. Businesses rely on analytics to analyze different types of data to make data-driven decisions, improve efficiencies, and discover new opportunities. Organizations primarily rely on two main types of data sources, internal and external. Internal data sources, also known as endogenous data, that come from within the company, such as ERP systems that track operations, general ledgers that record financial transactions, management reports that capture performance metrics. So these data provides detailed, reliable insights about how the business runs day to day. External data sources, also known as exogenous data, on the other hand, come from outside the organization, including customers, suppliers, competitors, investors, analysts, shareholders, and even social media, news media. These data help companies understand market trends, customer behavior, and external factors that may affect business performance. When combined internal and external data, it gives a complete picture, helping business make smarter data-driven decisions. And in today's data-driven environment, auditors and accountants have access to a broader range of information sources than ever before. Traditionally, all the evidence came mostly from endogenous data sources. However, auditors are now increasingly using exogenous data sources, which come from outside the company. Using both internal and external data allows auditors to form more reliable conclusions, helping identify risks, detect inconsistencies, and validate management's claims with independent real-world evidence. When we talk about data, we have to understand the concept of a big data. Big data refers to extremely large and complex data sets that traditional tools cannot easily process or analyze. To better understand big data, we often describe it using the 5 V's. First V is volume, which refers to the size or quantity or amount of data being generated, for example, in terabytes or even petabytes. The next V is variety, meaning data comes in many different forms, such as numbers, text, images, videos, or sensor readings. Then there is velocity, which highlights the speed at which new data is generated and needs to be processed, sometimes in real time, like streaming data from devices or online platforms. For example, social media posts are generated moments by moment, minute by minute, second by second. But an annual report or a quarterly report is going to only be generated annually or quarterly. The fourth V is veracity, which focuses on the accuracy and reliability of the data. Since not all data is clean or trustworthy, organizations must ensure that the data they are analyzing has high quality. Finally, the last V is value, the ultimate goal of big data, which turning all this information into meaningful insights that drive better decisions. Altogether, the five V's, volume, variety, velocity, veracity, and value, capture both the challenges and opportunities that come with managing big data in today's digital world. Last slide, we said variety refers to different types and formats of data that organizations use today. In the past, most data was structured, which is organized in rows and columns, like in a spreadsheet or database. But now we also work with unstructured or semi-structured data, such as text, images, videos, sensor readings from smart devices. This variety gives organizations richer insights, but also makes data management more complex. For example, auditors may need to analyze not only numbers, but also customer feedback, performance metrics, or visual data. So data variety shows how modern analytics must handle many different data types to create a complete picture of business performance. In the next few slides, we will see different types of data. First one is the financial data. This type of data provides a key insight into a company's financial health. A typical example is the financial statements, the balance sheet, income statement, statement of stockholders' equity, and so on. These data help auditors, managers, investors understand how well the business is performing and make informed financial decisions. The next type of data is non-financial data, which provides insights about a company beyond its financial performance. The example showing here, we can see board member details, such as their roles, independence, and experience, which reflect leadership quality and governance strength. This type of data helps stakeholders understand how management decisions and the company culture impact long-term performance, complementing what financial statements alone cannot show. Data can also classified as internal data and external data. Here, internal data is information created within a company through its daily operations, such as this example here, a sales ledger that tracks invoices, totals, and taxes. External data comes from outside the organization, such as market reports, stock prices, news articles, social media posts. Here we see examples from Yahoo Finance and employees' posts on Glassdoor. Most time, we are dealing with the structured data, which is information organized in a clear, predefined format. For example, in a tabular format showing rows and columns. Each row represents an object or record, such as a transaction or customer or entity entry. And each column represents an attribute or field, like a ticker, CUSIP number, recommendation code, announcement date. Unstructured data could have a variety of format as well. Could be news articles, research papers, employee reviews, emails, PDF files, videos, photos, or audio files. It's often text heavy and hard to organize, but it carries rich insights about opinions, trends, and behaviors. We can apply advanced techniques like text mining, natural language processing to make sense of this type of data and uncover insights that numbers alone cannot show. Sometimes we are dealing with human-generated data versus machine-generated data. Human-generated data is created through human manual input. For example, accountant enters month-end adjusting entries. Machine-generated data is produced automatically by the system without direct human involvement. For example, the entries marked with SAP SYS represents system-generated or automatic posting created by the company's ERP system like SAP. Machine-generated data is usually faster, more consistent, and less prone to human error. But both types of data support a company's financial and operational reporting. Sometimes we classify the data as quantitative data or qualitative data. Here, quantitative data represents information that can be measured or expressed numerically. The example shown here is the financial performance results, including revenue, net income, or earnings per share. All of these are numeric value that can be compared across time periods, reveal some trends such as growth or decline. Quantitative data is often presented into two types of categories, continuous and discrete. Continuous data can take on any value within a range, including decimals or fractions, like revenue or temperature or weight or height, so data is measured. Discrete data represents whole number or counts, like the number of customers or products sold, so data here is counted. Different from quantitative data, qualitative data represents descriptive, non-numeric information that provides context, meaning, and insights that numbers alone cannot capture. The example shown here comes from sections of an annual report, specifically the risk factors and management discussion and analysis, which is MD&A section. These narratives describe a company's strategy, potential risks, and business outlook in words rather than figures. So this type of data is essential in financial analysis, auditing, and decision-making process because it complements quantitative data by adding context and interpretation, right? It helps users to understand the story behind the numbers. This slide summarizes the different type of data we have discussed so far. Each category highlights how data can vary based on its source, format, and how it's generated or interpreted. Together, these categories show that modern organizations handle a wide range of data types, and understanding each is key to effective data analytics and decision-making. Here I have a polling question. When evaluating a company's performance, which of the following would be classified as qualitative data? A. Quarterly revenue. B. net profit margin, C, employee feedback about management culture, D, inventory turnover ratio. The correct answer is C, which is the employee feedback about management culture. This is a type of qualitative data because it describes opinions, perceptions, and experiences. It's non-numerical insights that provide context about a workplace culture. A, which is quarterly revenue, is a type of quantitative data since it represents a numerical value that measures a company's financial performance over time. B is a net profit margin is also quantitative data. It expresses profitability in a percentage, a measurable numerical indicator. D is inventory turnover ratio is another quantitative metric. It calculated using numbers to measure how efficiently inventory is managed. Let's look at the next polling question. You are analyzing customer payment behavior to detect potential credit risks. Which combination of data types and sources would provide the most comprehensive insights? A, internal structured data only, for example, sales ledgers and account receivable. B, external unstructured data only, for example, social media comments. C, both internal structured and external unstructured data, for example, payment history and customer reviews. D, random samples from the general ledger. So, in this case, the correct answer is C, both internal structured and external unstructured data. This is the best choice. Combining structured internal data with unstructured external data gives a holistic view. You can see actual payment patterns along with customer opinions from outside sources. A, internal structured data only. This data is useful because it provides numeric transaction-based information about customer payment. However, it only shows internal records. It doesn't reveal external factors like customer sentiment or financial reputation. B, which is external unstructured data only. Social media posts might capture customer sentiment, but on its own, it's incomplete. It lacks the hard facts about payment timing, amount, and consistency that come from internal records. D, which is the random samples from the general ledger. This data provides limited insight since it doesn't focus on credit-related behavior or include external perspectives. So it's too narrow and not targeted to the question. So the correct answer for this question is C. Let's continue the learning. For this section of learning, we will focus on the scales of measurements. Scales of measurement describe how data are categorized, ordered, and quantified, essentially the way we assign meaning to data values. They define what kind of mathematical or statistical operation can be performed on the data and help determine how you can analyze it. Earlier, we said we classify the data into two categories, qualitative and quantitative. And this categorization can be further broken down based on its characteristics and the levels of measurement skills. So qualitative data deals with descriptive information, things that can be observed but not measured numerically. So it's also called categorical data. Within this group, we can have nominal data, which simply categorizes information without any order. And we can have ordinal data, which still uses categories, but within a specific order or ranking. On the other hand, quantitative data deals with the numbers and the measurable quantities. It's also known as numerical data. it can be divided into interval data and ratio attribute. So nominal, ordinal, internal, ratio describe the level of measurement for individual attributes or variables. In other words, how you can interpret and perform operations on the values and how data can be measured, compared, and analyzed statistically. We can't apply the same statistical tests to all data type. So using the wrong test can lead to misleading results. In the next few slides, we will discuss each one of these categories. The first type of categorical qualitative data is nominal attributes, which categorize data without any ranking or order, such as gender, eye color, zip codes, or employee IDs. To analyze nominal data, we rely on descriptive statistics, such as the mode to show the most frequent category, or entropy to measure category diversity, or contingency tables to summarize relationship between variables, or chi-square to check for association between variables. So in short, nominal data helps us classify and compare categories. It's about grouping, not ranking. The next type of categorical qualitative data is ordinal attribute, which rank data in a specific order but without consistent spacing between values. For example, mineral hardness, grades, or street numbers, they are all showing orders but not exact differences. To analyze ordinal data, we can use techniques like the median, percentile to summarize order, rank correlations to compare rankings, and run tests to detect trends. Ordinal attributes help us to understand ranking and position, but not the precise amount of differences between categories. The first quantitative numeric data is interval attribute, where differences between values are meaningful, but there is no true zero. This means you can measure the distance between values, but you cannot say something is twice as much as something else because the scale doesn't start at an absolute zero. For example, calendar dates are interval data. The difference between January 1st and January 10th is 9 days, which is meaningful, but there's no zero date. Similarly, temperature in Celsius or Fahrenheit has meaningful intervals. A 10-degree difference means the same across the scale, but 0 Celsius or 0 Fahrenheit doesn't mean no temperature. Common operations for interval data include mean and standard deviation to describe central tendency and spread, and Pearce correlation can be used to measure relationships between variables. Statistical tests like t-tests, f-tests are also applicable because interval data supports arithmetic operations and comparisons. So in this case, interval data measures differences, not ratios. The next quantitative numeric data type is ratio, which represents the highest level of measurements. Because this type of data has all the properties of interval data, also include a true absolute 0 point. This allows for all mathematical operations, including multiplications, divisions, making ratio meaningful. Some examples are temperature measured in Kelvin, where 0 represents absolute absence of heat. Count, where 0 means no items. Mass and current both can have a value of 0 representing none and monetary amount, right? Age and the length, where 0 measures no money or no birth or no length. Since racial data supports full mathematical computation, we can use more advanced operations. Geometric mean is ideal for analyzing growth patterns. Harmonic mean works well with rates and ratios. Coefficient of variations helps compare variability across different data sets with different averages. So ratio attributes give us the most complete quantitative information. We can measure differences, ratios, and absolute quantities. Here's another polling question. An accounting firm classifies clients by risk level, low, medium, and high. Which level of data measurement does this represent? A, nominal, B, ordinal, C, interval, D, ratio. The correct answer is B, ordinal. Ordinal data involves categories with a ranked order, but the differences between levels are not uniform or measurable. Low, medium, and high represent increasing level of risk, but we cannot say how much higher one is than the other, right? This fits the ordinal level perfectly. Option A, nominal data, it represents categories without any inherent orders or rankings. For example, client names, regionals, or types of services. Since low, medium, and high have a clear order, this option is incorrect. Option C, interval. Interval data has equal measurable differences between values, but no true 0 point, for example, temperature in Celsius. The risk level is not measured in equal intervals, so this option doesn't apply. Option D, ratio. Ratio data has equal intervals and has a true 0 point, allowing for mathematical operations. For example, the income, we're talking about age, skills. Since low, medium, high, the risk levels are qualitatively ranking, not numerical values. So this is not ratio data. All right, let's move on. Now, let's look at how data is structured within a system. In most organizations, data doesn't live in just one place. It's spread across different applications and databases. So before we can analyze anything, we need to understand where the data is stored and how the pieces fit together. This slide highlights 3 key ideas. First, data exists across multiple systems. So part of our job is locating the right sources. Second, once we are in a database, we need to identify the specific tables and fields that contain the information we care about. That includes understanding the primary key, foreign key, and how tables are related to each other. On the right of the slide, you can see a simplified procure-to-pay schema. It maps out relationships among materials, suppliers, purchase orders, and order details. Visual diagram like this often created using UML, Unified Modeling Language, help us see how data flows across a process and where important attributes reside. The main takeaway here is that understanding the structure of your data is fundamental. When you know how the data is organized, you can extract it more accurately, draw it correctly, and ultimately perform better analysis. Relational databases are widely used in organizations to manage data. First, they help keep data complete and accurate. Because information is stored in structured tables, it's much easier to ensure that nothing important is missing. Second, relational database help avoid duplicate information. Instead of storing the same data in multiple places, they link related tables together. This reduces errors and saves storage. Third, they automatically enforce business rules. For example, a purchase order must have a valid supplier ID. The database won't allow entries that break these rules, which helps maintain data integrity. And finally, relational database make it easier for different business processes to work together. When the data is consistent and well organized, systems across purchasing, finance, inventory, and other areas can all access and use the same reliable information. So overall, relational databases create this structure consistency, which are essential for good analysis. Now we'll talk about how data is stored and how rules and controls are enforced in a relational database. Let's look more closely at the types of attributes we find in a table. In particular, we focus on 4 key attribute types: primary keys, foreign keys, composite keys, and descriptive attributes. Every table in a relational database must have a primary key. This is required because the primary key uniquely identifies each record in the table. For example, in the purchase order table shown here, the primary key is the purchase order number, PO number. You can see that each value 1787, 1788, 1789, and so on is a unique number here. Foreign keys work hand in hand with primary keys. They create links between tables. In the earlier schema we looked at, the suppliers table connected to the purchase order table, and the purchase order table connected to the purchase order details table. These connections exist because a foreign key is in one table points to the primary key in another. In this table, attributes like created by, approved by, supplier's ID, employee ID, cash disbursement ID are all foreign keys. Each one references another table to tell us who created the order, who approved it, which supplier it relates to, and so on. Next, we have composite key. These occur when 2 foreign keys are combined to uniquely identify a record, commonly in line item tables, such as purchase order details. Sometimes a single attribute isn't enough to uniquely define a record, so the database uses 2 attributes together. And finally, descriptive attributes. These are all the other fields in a table that simply describe characteristics of the record, but do not define relationships with other tables. In our example, the data column is a descriptive attribute because it tells us when the purchase order was created, but it doesn't link to any other table. So in summary, primary keys identify records. It's required for every single table. Foreign keys connect tables. Composite keys uniquely identify line items, and descriptive attributes provide additional context. On this slide, we are looking at an example of how 2 tables in a relational database connect to each other. On the left, we have the purchase order table, and on the right, the purchase order detail table, which stores the line items for each order. The key thing to notice is the PO number column. In the purchase order table, PO number is the primary key, which means each number appears only once and uniquely identifies a purchase order. Now, looking at the purchase order detail table on the right, here PO number appears again, but this time it's a foreign key. That means it points back to the primary key in the purchase order table on the left. This is what creates the relationship between the two tables. You will also see that PO number repeats in the detail table on the right. That's because one purchase order can have multiple line items. So for example, PO number 1787 appears twice because that order includes two different items. This is the essence of how relational databases work. A primary key in one table connects to a foreign key in another, allowing us to link information across tables without duplicating data. Understanding these primary key and foreign key relationships is essential for drawing tables, building queries, and performing accurate analysis. A data dictionary is essentially the rulebook for a database. It tells us exactly what each attribute in a table means and what kind of data is allowed. For every attribute, the data dictionary explains whether it's a primary key, a foreign key, or neither. It also tells us whether the value is required, what type of data can be stored, such as numbers or text, and how much data the field can hold. If we look at the example on the right, we can see how this works, right? The supplier's ID is marked as a primary key and is required. It's defined as a number with a field size of 10. The supplier's name isn't a key, but it allows short text up to 30 characters. And the supplier's type is marked as a foreign key with notes explaining what each code means. So the data dictionary gives us clarity and consistency. It helps ensure that everyone entering or using the data following the same rules, which is essential for data quality and reliable analysis. Understanding data types is the first step in designing reliable databases or understanding the relationship in a database. This slide covers what are the different data types used in a database. Databases organize data into different types to ensure consistency and efficiency. The first group is string types, such as a char or varchar, C-H-A-R, or the VAR, CHAR, which store letters, numbers, or symbols. Char is fixed length, while varchar allows a variable length text. It's useful for names or descriptions. Longer text, like survey responses or comments, is stored as text or blob. Blob is a binary large object, is a data type used to store large binary data like bytes rather than characters, such as files, images, videos, audios, and any unstructured data that isn't plain text. The second group, numeric types, includes integer int, small int, and big int for whole numbers or integers, and float, double, decimal for decimal or fractional values. Float and double are used for approximate values, while decimal ensures exact precision, such as in financial data. Finally, logical data type includes Boolean value, which means true or false, and date time or timestamps for tracking when event occur, and time data, which stores the time value. Choosing the right data type is critical in database. It affects storage efficiency, accuracy, and performance in every database application. Knowing data types and measurements classification is essential in data analytics because it affects how data is stored, processed, and analyzed. Each data type, for example, integer, float, string, date, time, Boolean, represents different kinds of information. For example, 25 could mean an integer, or for example, age, or a string 25 Main Street. That's an example. Understanding data type ensure you interpret the data correctly. Different types support different operations. We can add two numbers, but not two text strings unless we explicitly convert them. Date and time data types allows us to compute durations, while categorical data supports grouping and counting. So knowing data types helps prevent invalid or misleading computations. Data types determine how much memory is needed and how efficiently data can be processed. For example, storing numerical data as a text with memory and slows computation. So choosing the proper types, for example, we could use INT8 instead of INT64 when possible, which can optimize the performance of the computer. Recognizing data types helps detect errors and inconsistencies. If a numerical column contains strings like not applicable or unknown, that indicates a data quality issue. So checking the types is a common first step in data cleaning. Analytical techniques depends on the data types. For example, if we're dealing with a numerical data type, we can use a mean, correlation, and regression analysis. If it's categorical data type, we can perform frequency count, mode, chi-square tests. If it's date or time data, we can use a time series analysis. So misidentifying the data types can lead to invalid analysis. Corrective data type also ensures visualization accuracy. Charts relies on correct data types. A lie chart needs continuous numeric or date time data, not strings. Categorical data fits better with bar chart or pie charts. Proper data type ensures meaningful visualizations. So in short, getting data types right means cleaner, faster, and more reliable analysis results. So here we have another polling question. Which data type would you use to store currency values accurately? For example, $123.45. A, float, B, double, C, integer, D, decimal. Option A is float, which is not ideal for currency. Float is an approximate value type. It can cause rounding errors due to the binary representation of decimals. For example, 0.1 might be stored as 0.999998. This is fine for scientific or statistical data, but not for money. Option B, double, similar to float, but with a higher precision. However, it still stores approximate values, making it unreliable for exact currency calculation. Option C, the integer, only stores whole numbers, so it cannot handle cents or fractional values like the $123.45. So the correct answer is D, decimal. Decimal stores exact numerical values with a fixed precision. This avoids rounding issues and ensuring accuracy for monetary amount. For the next few slides, we will discuss the different ways that data can be represented depending on its format, structure, and purpose. These representations highlight how data varies across different contexts, from static tables to dynamic real-time or multimedia systems. Let's see some examples. Record data is one of the most common forms of structured data. It's organized in a table format or tabular data, where each row is an object, like a student in our example here, and each column is an attribute, like the age or GPA displayed on the example here. Attributes describe characteristics, while objects are the individual records being described. So this format, tables of consistent rows and columns, is the foundation for most databases and analytical tools because it's easy to organize, query, and analyze. Matrix data represents information in a structured numerical grid, an M times N matrix, where M is the number of rows or objects, and N is the number of columns or attributes. In this example, each row represents a product such as a laptop or printer, and each column represents a sale of region, north, south, east, and west. The value in each cell shows the sales amount for that product in a specific region. So this structure makes it easier to analyze numerical patterns, for example, comparing sales performance or calculating totals. Matrix data is a foundational format in analytics and machine learning, allowing mathematical and statistical operations to be performed efficiently. The next one is document term matrix. It is to convert each document to a term vector. The object is each document and attribute is the number of times the corresponding term appears in that document. For example, each document is represented by term frequency for each attribute. The table here, document term matrix, quantifies how often specific terms appear in each document. Higher numbers indicate greater importance or relevance. Transaction data, this is similar to business transaction information. In accounting and auditing, transaction data captures sets of accounting activities that occurs together rather than isolated data point. Each transaction links multiple accounts, for example, cash, sales revenue, the VAT payable table. It forms a set of related items that accountants and auditors need to analyze them together. Time series data consists of observations collected sequentially over time, where order matters. Each data point represents the value of a variable at a specific time interval, such as a daily, monthly, or yearly. The temporal order of data point is crucial because earlier values often influence later ones. So a line chart helps visualize continuous changes over time. It is particularly useful in accounting analytics to study the trend of revenue growth or market performance. Sequential data captures ordered events or activities over time. Each step depends on the previous one. So in auditing, this can represent an event log or approval workflow. This process flow shows a sequence of audit-related events starting from user login, data entry, moving through approval and posting, and ending with audit review. Such a sequential data helps auditors identify process bottlenecks, unusual event orders, or missing approval steps in workflow logs. The relationship among objects frequently convey important information. Sometimes it's easier to convey that information visually via graph. Many different forms of graph-based dataset, such as molecular graph or linked web pages. Nodes represent entries. Edges show the relationships. Network analysis helps auditors spot risks such as a single approver authorizing many invoices or across links between vendors and invoices. For example, we rely on network data to perform related party detection, segregation of duties checks, and unusual payment pathways in the account payable or account receivable networks. Spatial data, also called geographic data, information that includes a geographic component, such as coordinates, latitudes and longitudes, the maps or satellite imagery. It allows us to connect data to real-world locations, for example, showing where events, assets, or customers are located. When the spatial data combines with the time, it is known as the spatial temporal data. Like the example shown on the slides illustrates global temperature data. Each color represents the temperature values across different geographic locations, while the month label on the top indicates this map shows data for a specific point in time. Multimedia data refers to complex, unstructured data type, such as images, audio, video. Unlike structured data in databases, multimedia data doesn't fit neatly into rows and columns. It requires specialized processing techniques to extract those meaningful information. Examples include speech recognition, where spoken words are converted to text, and images or video analysis used for detecting objects or patterns. Relational data is organized into multiple interconnected tables that are linked through keys and defined relationships. This structure, common in relational database like SQL, makes it easier to organize, query, and maintain large data sets efficiently. The example here shows a linked business process where each step from purchase requisition to invoice receipt is connected through relational links, reflecting how data flows across different systems. Data streams refer to a continuous, real-time flow of data that must be processed immediately as it's generated. They come from sources like social media, sensors, autonomous vehicles, and so on. For example, tweets about city issues or car sensor readings are analyzed live to detect problems or trigger certain actions. So we have gone over different types of data so far. Now let's move on to this polling question. An auditor reviews a company's database containing details of each sales invoice, including date, customer, items sold, to identify unusual purchasing patterns. Which type of data representation is the auditor analyzing? A. Record data. B. Transaction data. C. Time series data. D. Matrix data. The correct answer is transaction data. Transaction data captures details of individual business events, like sales invoices, purchases, or payments. Each transaction includes items bought, quantities at what price, and timestamps, and so on. So this is exactly what an auditor would use to analyze purchasing patterns or detect any anomalies. So the correct answer is B. Option A, record data, which represents structured data in rows and columns, such as a student database with attributes like names, ages, and GPAs. However, this question focuses on individual transactions, not general records, so it's not the best fit. Option C, which is a time series data, tracks how a single variable changes over time, such as daily sales totals or monthly revenue trends. The question doesn't focus on continuous time tracking, but on discrete transactions, so this is not correct. Option D, matrix data, organizes values in a grid format for analysis, like product sales across multiple regions. It's used for aggregate data comparisons, not for analyzing individual transaction records. So for this question, the correct answer is B, transaction data. The next topic is focusing on the data quality, right? How is data quality? Poor data quality can have a significant negative effect on data processing and the accuracy of analysis results, especially in an audit. If the financial information you received has bad quality and a lot of mistakes, it will significantly impact your audit quality. Therefore, when we are analyzing different types of data or data sets, we need to first evaluate the data quality. Several problems that users can check whether the data set contains noises or outliers, right? Noise is the random component of a measurement error. It may involve the distortion of a value or the addition of a spurious object. More noise in the dataset may bias your decision. Outliers are their data objects that have different characteristics from most of the other data objects in the dataset, or the values of an attribute that is unusual compared to the typical values for that attribute. Missing value or transactions are common when analyzing a data set. However, a user should find a way to deal with missing data, delete the missing value record, or follow up with the client to fill in the missing values. Duplicate data is another problem we often see. Users should determine whether the duplicate records are legitimate. For example, the same employee with multiple email addresses or titles. This could also be inconsistent values. So the next problem is inconsistent values. For example, the zip code is not matching with the city indicated in a dataset. This type of a problem should be corrected before performing further analysis. The quality of the data will affect the quality of the insights and the decisions based on them. In other words, bad data leads to bad decisions. The structure of the data will determine how effectively they can be analyzed. Dirty data causes business to lose billions of dollars every year. These data provides inaccurate or incomplete descriptions of the economic activities of a business. So using dirty data can lead to, for example, inaccurate pricing, sending bills to the wrong customers, or not collecting them at all, inability to detect fraud. Data preparation can help avoid these issues. It's the process to profile, clean, restructure, and integrate data prior to processing and analysis. It helps ensure high-quality data and improve the decision-making. Let's first look at the data profiling. Data profiling is the process of investigating data quality and structure. It mainly has three parts. First, investigating data quality. This refers to search for anomalies in the data and to answer the question, are the data dirty? Second, investigating data structure. This refers to find the best way to organize the data and improve analytics. Third is deciding and informing. This refers to make decision about whether it's possible to address the identified issues, what the cost of doing so would be, and consider the possible consequences if the issues are not addressed. So let's look at the first part of data profiling, investigate the data quality. When discussing the quality of the data we work with, we are referring to the suitability of using the data for decision making. We use a different method to assess data quality. The first one is the rule-driven method, which is a top-down approach. A logical relationship or rule is defined among data and tested to determine if the data conform to it. The number of rules that can be specified is nearly unlimited. For example, quantity on hand cannot be negative. A car cannot be rented to someone who is younger than 16 years old. Sales can only be executed with a valid order. The second method is the exploration and inference method, which are bottom-up approach. The goal is to find anomalies by examining the data from many different perspectives. We can perform sorting, frequency distributions, and outlier analysis for exploration purposes. For inferences, we normally rely on computer algorithms to identify anomalies. These different methods identify data anomalies which occur when the data do not meet expectations of correctness, validity, consistency, and completeness. Data describes the facts about entities, such as the name of a customer, the price of a product, the date of a transaction. Data are incorrect when the value assigned to an entity's characteristics is wrong. Incorrect data are common. Profiling techniques such as exploring outliers can be useful in detecting this type of errors. Another integral part of data profiling is designing the validation rules. These rules define what values are and are not acceptable, and they can take many shapes and forms. Validity and correctness are sometimes confused. Here, incorrect value means the wrong value is assigned. An invalid value means an unacceptable value is assigned. For example, in a data set, the state for a customer needs to be presented as two letters. For example, Connecticut needs to be presented as a CT. Incorrect value means the state CT is presented as NY or NJ. Wrong value is entered. Invalid value means CT is being entered as the full name Connecticut. In addition to being correct and valid, data should be consistent. Data inconsistency occurs when the same characteristic is represented multiple times. Using both CT and Connecticut to refer to the same state would create data inconsistency, right? How can we identify inconsistencies in a data set? Here are two profiling techniques. Create a list with all distinct values, then sort and review. The inconsistent values will most likely be noticed. Second is we can build a frequency table. On a table that counts how many times a value counts. So the values with a low frequency might indicate inconsistent data. Data that is correct, valid, and consistent are only accurate if they are all complete, as non-complete data may result in distorted insights. Data can be incomplete in two ways. First, a missing instance is when a concept occurred but is not recorded, such as when goods were sold, but the sales transaction were not recorded. If there is a sequential number for each sale invoices, then a missing record can be identified. Second, a missing value occurs when the transaction is recorded, but we do not have information for all characteristics. The result is empty sales. So this might happen if a customer is recorded, but the record does not include the customer's email address and so on. So in this case, we will see some null values in the dataset, which are those missing or unknown values. Here is another polling question. A financial auditor uses frequency tables to identify unusually high numbers of transactions just below the approval limit. Which data profiling approach best describes this activity? A, rule-driven, top-down. B, integration-driven. C, standardization. D, exploration, which is bottom-up. The correct answer is D, exploration bottom-up data profiling. It involves examining the data directly to discover patterns, irregularities, or any anomalies without relying on predefined business rules. So in this example, the auditor is exploring the data by analyzing transaction frequencies. They notice a suspicious pattern. Many transactions occur just below the approval limit, which may suggest attempts to avoid authorization controls or potential fraud. So this discovery comes from the data itself, not from checking against a fixed rule, making it a bottom-up process. In the opposite, if the auditor were validating transactions against a policy, such as no purchase over 5,000 without manager approval, that would be a rule-driven or top-down profiling. Integration-driven focus on comparing and aligning data across multiple systems. For example, checking if customer IDs match between billing and the database. It's about data consistency, not anomaly detection within one data set. Standardization ensures the data follows consistent format or conventions, like converting all dates to the same format or units to the same scale. While important for data quality, it doesn't involve analyzing patterns, so it's not relevant here. All right, I hope you enjoyed this video. If you have any questions, please feel free to reach out to me. Thank you for watching.